Banking didn't start with apps or plastic cards. It started with one problem: trust across distance. Once banks learned to turn trust into numbers, everything changed. Trade expanded, empires scaled, and modern life became possible. Stay with me, because this system is older than you think, and it still runs your life quietly, every day. Imagine a world with no banks, no accounts, no transfers, no loans, no credit scores. You can only buy what you can carry. You can only save what you can hide. And you can only trade with people you know. That world isn't just inconvenient, it's small. Small worlds don't build global economies. They don't build modern trade. The core problem is trust, and trust is expensive. If I give you goods today, how do I know you'll pay later? If I ship across a sea, how do I know I'll get paid? If I lend you money, how do I know you won't disappear? Without trust, long-distance trade collapses into fear, and fear kills scale. Early trade used reputation. Families, guilds, and merchant networks trusted each other. But reputation doesn't scale forever. The moment you trade with strangers, risk explodes. So civilization needed a tool, something that could manufacture trust between strangers. That tool was the ledger, and the ledger changed everything. A ledger is a memory system. It records who owes what, to whom, and when. Once obligations are recorded, they can be enforced. Once they can be enforced, trade can grow. That's the first big idea. Banking is not money, it's accounting. Not just coins and notes, records, balances, and promises. And those promises become powerful when society agrees they're real. Most money you use isn't physical, it's entries in accounts. When you check your balance, you're not looking at cash. You're looking at a number in a system. That number is trust. Trust that you can spend it and others will accept it. So, how did banks turn trust into numbers? It starts with deposits. People needed safe places to store valuables: gold, silver, and later cash. If you hold wealth at home, theft is always possible. If you store it with a trusted keeper, you gain security. At first, banks were vaults. You deposit valuables and receive a receipt. That receipt proves ownership. It can be redeemed later. But then the receipt becomes useful on its own, because paper is easier to move than gold. Instead of carrying metal, you carry proof, and proof becomes portable trust. So the receipt starts circulating, and suddenly trust can travel. If I owe you money, I can hand you my receipt. You accept it because you trust the keeper behind it. That's the moment banking becomes a network effect. It's not just storage, it's transfer. And once transfer exists, trade gets faster. Deals become less risky. Trust stops being personal. It becomes institutional. Now comes the most important leap: lending. Banks realized something uncomfortable. Not everyone withdraws deposits at the same time. So a bank can keep some reserves and lend the rest. That creates profit, and it creates risk. But it also creates credit, and credit is fuel. This is how banks create money-like power. When a bank makes a loan, it often creates a balance. It doesn't always hand over physical cash. It creates numbers in your account. Those numbers can be spent, so the bank didn't just move money, it expanded it through trust. That's why banking scales economies. It expands what's possible. Credit powers growth. Businesses borrow to expand, and people borrow to buy homes. Governments borrow to fight wars and to build infrastructure. The modern world is built on borrowed money, and borrowed money is built on banking systems. So yes, banking doesn't just support the economy, it shapes the economy. Once lending exists, a new problem appears: clearing. If many banks exist, they must settle payments between each other. Otherwise, every transaction requires moving cash across cities. That's slow and dangerous. So banks build clearinghouses, and clearinghouses change the game. A clearinghouse is where banks reconcile obligations. It nets out flows. Bank A owes Bank B. Bank B owes Bank C. Bank C owes Bank A. Instead of moving cash constantly, the system settles the difference. Clearing turns banking into a true network, and networks create dependency. Once you rely on clearing, you can't easily leave. You're tied into the web. And as the web grows, crises become inevitable because trust can break. If people panic and withdraw at once, banks can collapse. That's a bank run. A bank run isn't just financial, it's psychological. It's trust collapsing in public. So states step in. They create central banks and lender of last resort systems. They add regulations, reserve requirements, and oversight. This stabilizes the network, but it also ties banking to political power. And once money meets politics, everything changes. Because money becomes policy, interest rates become tools, inflation becomes strategy, credit becomes leverage. Banking stops being just a private service. It becomes a core function of the state and economy. And that means banking shapes society, not just markets. Now here's the hidden magic of banking: time. Banks don't just store money, they move value through time. They take savings today and turn them into investment tomorrow. That's how growth accelerates. But time also creates fragility because promises can break. If too many people demand money back at once, the system strains. If loans go bad, trust evaporates. When trust evaporates, numbers stop meaning anything. That's why banking is powerful and scary. It can build cities and it can collapse fast. Because it's built on belief and coordination. Now here's the modern twist. Digital banking didn't change the core logic. It made the ledger faster and more connected. Your money still lives as numbers in databases. Payments still flow through clearing networks. Credit still expands and contracts. The machine is the same, just faster. And that's why banking runs everything. It decides who gets loans and who gets denied. It decides which businesses can grow. It shapes how governments fund themselves. It sets the price of risk. It sets the price of time. And it shapes what the economy becomes. Quietly, but constantly. So what does it mean that banking turned trust into numbers? It means society built a machine for belief. A machine that records promises, prices risk, and moves value across distance and time. Once that machine scaled, it became unavoidable. You can't build a modern economy without it. And you can't escape it without leaving the system. So next time you check your bank balance, pause. You're not looking at physical money. You're looking at a trust score inside a giant ledger system. And the reason it works is simple. Everyone agrees to treat those numbers